In March of 2009, Skynet took over the equity markets, and the markets will never be the same again. High-frequency trading, program trading, algorithmic trading, they're all part of the same landscape we're faced with today, and some of these unregulated and unfair practices threaten the structural integrity of our markets. Yes, that's 100% right. Not only is Skynet largely unregulated, but most of the folks we pay to participate in trading are in bed with these guys, one way or another, because it is so profitable to screw you. Did you know that almost all of the big name brokers sell your order flow to a third party? That's right. Interactive Brokers is the only one that I know of that does not. And the exchanges, they actually sell floor space next to the exchange computers to our direct competitors so that our competitors' servers can more efficiently front run us. Until this parasitical form of market participation is properly regulated, all discretionary traders have a significant problem to deal with. You don't think this is a big issue? One example, just one day, program trading averaged over 90% of the volume from June 18th to June 22nd, 2012, and it's not any better today. Here's what most people get wrong. They believe high-frequency trading is only parasitical. The cost of doing business after Judgment Day. It is not. If it were only a matter of you and I paying half a cent more on a buy order, I wouldn't worry. I'd pay it and just shut up. Just another form of old specialist order system flow, right? Wrong. The net effect of this front running is to deny us a fill. Think about it. Your order flow is sold, or your order is sensed by high-frequency traders and front-run by 1/10 of a cent. On a 10,000 share order, you get 85 shares. It's a big winner, and you are largely unfilled. Now, let's say you have a great strategy, that's right, like we've developed, and you are directionally right 8 out of 10 times. Unless you know how to handle this program trading problem, you don't get filled when you are right, but of course you get filled when you're wrong. Replicate this 10,000 times over, month after month, and you've driven out many of the short time frame traders because they can't make any money, thereby leaving only computers in control. So what's wrong with that? Why are you worried about computers being in control? High frequency voice provide liquidity, right? That's a fantasy. That gives regulators cover for inaction. The reality is these high-frequency trading guys have learned to flip the switch off when things get wild, so humans are gone as well as the computers. That lie that these high-frequency traders supply liquidity is absurd. When you need liquidity, no one's home, and you get what we got on May 6, 2010, a 1,000-point drop in the Dow in minutes. Listen, we won't have a bull market forever, and when the you-know-what hits the fan, we could easily end up with a systemic break. Then finally, we might get the regulation we need. Is it as bad in the futures markets as in the stock market? No, but there is arbitrage between these markets. That can make the situation even worse. I remember trading in October 1987 when the premiums between cash and futures got totally out of whack. Offsetting orders placed in futures were wildly expensive. They will be again. If you haven't gotten the picture yet, let me give you a visual. You were paid to enter a game of poker, but you got the cheap seats. The people that you would pay the entrance fee to have sold the expensive seats to your competitors. Now, there's a mirror set up right behind you so the guys in the expensive seats can see your hand. That's what makes them the expensive seats. If you're trading short-term time frames, it is incumbent on you to understand order flow, how to cancel replays, when to go to the market, when you need to go to bracketed limit orders. The good news is that barring a systemic break, leading indicators that we teach go a long way to help you cover that mirror and sidestep Skynet. Joe DiNapoli here. I'll be back.